Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Buckle up, because today we're diving headfirst into a stack of reports that are painting a pretty wild picture of the markets. It's March 13, 2025, and things are moving fast.
It's a whirlwind out there, isn't it? We've got everything from AI shakeups to whispers of new CEOs and even some surprising international deals. It really highlights just how interconnected the financial world is becoming.
Absolutely. Okay, let's jump right in with MarketWatch, which has a story about Adobe struggling to keep up in the AI race. They beat revenue expectations, pulled in a solid $125 million in AI bookings, but their stock still tumbled 4% after hours. Wall Street is calling them an AI laggard. It seems like they're putting their money where their mouth is, so why the skepticism?
You've hit on a key point there. Investors are getting more sophisticated when it comes to AI. It's no longer enough to just talk about AI integration. You have to show how those initiatives are translating into cold, hard cash. The market wants to see a clear path to profitability, not just promises.
So it's not just about how much AI company is doing, but how well they're turning it into a money-making machine.
Exactly. And this is where things get really interesting. MarketWatch also has a piece about DeepSeek, a Chinese AI startup that's making waves but turning down investors left and right. Their founder, Liang Wenfeng, wants to stay in control and avoid outside influence, especially from government-linked investors.
Wait, turning down money. That's a bold move, especially in the competitive world of tech startups. What's the strategy there?
Wenfeng seems to believe that DeepSeek's real value lies in its independence. He's concerned that ties to Beijing could actually hurt their chances of becoming a global player. This situation really highlights the tricky intersection of technology, finance, and geopolitics in today's world.
It seems like DeepSeek's success compared to Adobe's struggles might be a sign that investors are starting to question who the real leaders in AI are. Maybe it's not the big names we're used to.
That's a very astute observation. DeepSeek is shaking things up and forcing the market to reevaluate what success looks like in the AI space. And it's not just about the technology itself. It's also about strategy, leadership, and even a company's core values.
Speaking of leadership, there's been a big change at the top over at CIBC MarketWatch reports that Harry Cullum, who started as an intern at their Vancouver office years ago, is now taking over as CEO. Talk about a career climb. What do you think this means for CIBC? Could this be a sign of positive things to come?
Cullum's rise through the ranks is a compelling story, for sure. He's taking the reins from Victor Dodig, who spent over a decade at CIBC and led them through some significant transformations. Dodig oversaw the acquisition of Costco's Canadian credit card portfolio, the construction of their new Toronto headquarters, and even the purchase of Private Bancorp in Chicago back in 2017. During his tenure, CIBC's U.S. profit share jumped from a tiny 2% to a whopping 20%. That's some serious growth.
Wow, that's quite a track record.
Right.
What can we expect from Cullum, though? Will he follow a similar path, or does he have a different vision for the bank's future?
That's the million-dollar question everyone's asking. Under Dodig, CIBC really focused on wealth management and commercial lending in the U.S., which is a different approach than rivals like TD Bank. TD, by the way, is currently facing some growth restrictions after an anti-money laundering settlement. It'll be fascinating to see how Cullum chooses to navigate this landscape and what his leadership style brings to the table.
This is a great reminder for our listeners that leadership changes can have a huge ripple effect on your investments. So it's definitely something to keep an eye on.
Yeah.
Now let's move over to Intel, where MarketWatch has another interesting CEO story. Lip Buchanan is returning to Intel as CEO. He actually left their board just last August, reportedly, because he disagreed with former CEO Pat Gelsinger's plans. So will he split Intel? What do you make of this?
This is where things get really fascinating. Tan has a reputation for making big moves. During his time as CEO of Cadence Design Systems, their stock value increased by over 3,200%. That's not a typo, folks, 3,200%. He definitely knows how to drive value.
3,200%. Okay, you've got my attention. So is he Intel's savior? What are the possibilities here?
There are rumors swirling about a potential takeover or a joint venture with the Taiwanese chip giant TSMC. They could potentially take over the operation of Intel's factories, which have been a major money pit for Intel. However, there's a catch. They use different technologies. It's a complicated situation, to say the least.
This is getting juicy. Will he split Intel, go for the merger, or come up with something completely different? It's a tech thriller in the making.
Yeah.
But before we dive into more corporate drama, let's take a look at the global scene. Bloomberg is reporting that oil prices are slipping even with news that U.S. inflation is finally cooling down.
You're right. The International Energy Agency, or IEA, is waving a big red flag warning that oil consumption is under pressure because of the ongoing trade war. It seems those trade war jitters are overshadowing even the positive news about inflation, at least when it comes to oil.
So for those of us at the gas pump, does this mean prices will stay low? What's the outlook?
It's tough to say for sure. Remember, the IEA is projecting that global oil supply will actually exceed demand this year by roughly 600,000 barrels per day. But with so many factors at play, the situation is incredibly volatile. We'll have to wait and see how things unfold.
I'm getting whiplash from all these twists and turns. But before we move on to the next batch of headlines, let's check in with the overall market sentiment. MarketWatch has a piece highlighting how some investors see this recent market dip as a prime buying opportunity. Fundstrat's Tom Lee, known for his optimism, points to historical trends where stocks bounced back after similar rapid drops. Are we seeing a repeat performance?
Tom Lee is definitely a glass half full kind of guy, and his analysis of historical patterns is intriguing. He argues that the market's expectations for a U.S. recession are exaggerated, citing the relative calmness in the corporate bond market and the continued growth in European and Chinese markets.
There's a but coming, isn't there?
Of course, Goldman Sachs is taking a more cautious approach, recommending defensive stocks over those trendy high-growth sectors. They're not as convinced that this dip is a guaranteed buying bonanza. Remember, there's always risk involved in the market, no matter how tempting a dip might seem.
So we've got optimism from Lee and caution from Goldman. Sounds like a typical day on Wall Street. What's the key takeaway for our listeners who are trying to make sense of all this?
I think it underscores the importance of having a clear investment strategy and understanding your own risk tolerance. Are you comfortable riding out potential volatility, or do you prefer a more conservative approach? There's no right or wrong answer, but knowing your financial goals and comfort level is crucial.
Now, for a curveball, Pokemon Go is heading to Saudi Arabia. Really? MarketWatch is reporting that Niantic, the company behind the augmented reality hit, is selling its gaming business, including Pokemon Go, to Scopely for a cool $3.5 billion.
Yeah.
And get this, Scopely is backed by Saudi Arabia's sovereign wealth fund.
This is definitely an unexpected twist. It seems like Niantic has been struggling to recapture the magic of Pokemon Go and is now shifting its focus to its geospatial AI business, Niantic Spatial. They'll be receiving a $250 million investment from Scopely for this new venture, which is a pretty strong vote of confidence.
What does this sale say about the gaming industry? Are we going to see more Saudi influence in this space?
This deal definitely signals Saudi Arabia's growing appetite for the gaming industry. And it's not just them. Sovereign wealth funds from around the world are increasingly investing in tech and entertainment. It's a trend worth watching closely.
Okay, back to tech stock analysis. This time, it's NVIDIA MarketWatch reports their stock is bouncing back. But BofA analyst Vivek Arya is urging investors to look past the AI hype and focus on something much less flashy: profit margins.
Arya makes a very valid point. NVIDIA's gross margins peaked at a whopping 79% last year during the Hopper product cycle. Now they're down to 73%, partly due to the transition to their new Blackwell product line. He believes a recovery to the mid-70% range is critical for a sustained stock rebound.
So it's not just about shiny new AI products, but the nitty-gritty details of profitability.
Absolutely. Understanding these less glamorous metrics is essential for making informed investment decisions. It's a reminder that even in the world of high-flying tech stocks, the fundamentals still matter a great deal.
This is just part one of our three-part deep dive today. We've got a lot more ground to cover, so stay tuned for more financial insights.
You know, it's fascinating how a single company can really shake up an entire industry. Take DeepSeek, for example. Their meteoric rise is forcing everyone to rethink what's possible in the AI landscape.
I totally agree. And their founder's decision to reject investors, especially those with government ties, is a bold statement. It's clear he's prioritizing control and global reach over a quick influx of cash. This raises some interesting questions. What does this mean for the future of AI development? Could we see a shift towards more independent, even defiant players in the tech world?
That's certainly a possibility worth considering. DeepSeek's stance could inspire other startups, particularly those in sensitive sectors, to really scrutinize their funding sources and the potential strings attached. The implications for innovation, competition, and even national security are huge. It's a high-stakes game for sure.
Let's shift our focus back to the U.S. market for a moment, where investors are grappling with some pretty wild swings. We've got Tom Lee from Fundstrat waving the buying opportunity flag, while Goldman Sachs is preaching caution. It's enough to make anyone's head spin.
The contrast in perspectives is striking, isn't it? Lee's bullishness is grounded in historical trends and his belief that recession fears are overblown. He's even suggested that the Fed put might be back in play.
Hold on, Fed put. Can you explain that for our listeners who might not be familiar with the term?
Of course, the Fed put refers to the idea that the Federal Reserve might step in to support the market if things start to go south. It's based on the belief that the Fed wants to avoid a major market crash and will take action to prevent it. Some investors see this as a safety net, but it's not that simple.
So it's not a guaranteed bailout for reckless investors.
Exactly. While the Fed has intervened in the past, it's not a foolproof solution. And even if they do step in, it doesn't mean the market will magically recover overnight. The market's reaction is always unpredictable, and there could be unintended consequences.
Got it. No free passes. Now let's circle back to the Pokemon Go heading to Saudi Arabia story. I'm still processing that one. What does this sale mean for Niantic in the long run? Are they essentially giving up on the gaming side of their business?
It's a strategic move, that's for sure. It seems they're doubling down on their geospatial AI business, Niantic Spatial, and they have a $250 million investment from Scopely to help them do it. This suggests a calculated shift in focus, not necessarily a complete surrender. Remember, they've had a tough time replicating Pokemon Go's massive success, so this could be a way to cut their losses and reinvest in a potentially more lucrative area.
It's interesting how this deal connects to Saudi Arabia's larger ambitions. They're clearly not content with just being an oil powerhouse anymore. They're actively branching out and diversifying their investments into tech and entertainment. It raises some big questions about their long-term strategy and the potential geopolitical implications.
Absolutely. This deal is just one piece of a much larger puzzle. Saudi Arabia's public investment fund, their sovereign wealth fund, has been making waves with investments in everything from esports to electric vehicles. They're clearly positioning themselves as a major player in the global economy, and the Pokemon Go acquisition is a prime example of that.
Okay, let's zoom back in on the tech sector, where NVIDIA is generating buzz with their stock rebound. But as we heard from Vivek Arya at BofA, the real story might be their profit margins, not just the AI hype.
Arya's focus on gross margins is a refreshing dose of reality in a market that often gets swept up in exciting narratives. He's reminding investors that sustainable growth is built on strong fundamentals, and that includes healthy profit margins. It's easy to get caught up in the allure of cutting-edge technology, but those profit margins are what ultimately determine a company's long-term viability.
So it's a cautionary tale for investors who are tempted to chase the latest shiny object. The excitement around AI is undeniable, but the numbers always tell a more nuanced story.
Yeah.
Speaking of numbers, let's talk about stablecoins. Remember that bill we touched on earlier, the Genius Act, which is aimed at regulating these digital assets?
Mm-hmm.
It seems like there's a lot of debate about its potential impact, especially with the possibility of an Elon Musk stablecoin X money entering the picture.
The irony: a bill designed to regulate stablecoins might actually pave the way for Elon Musk to launch his own, potentially making the situation even more complex. Senator Warren has expressed concerns about big tech taking control of the U.S. dollar, while Senator Gillibrand argues that the law is crucial for maintaining the dollar's dominance globally. It's a classic clash of ideologies.
So who's right? Is this bill a recipe for disaster or a necessary step towards harnessing the potential of stablecoins? And what about consumer protection? The bill doesn't offer the same safeguards as those governing credit cards or peer-to-peer payment platforms. What happens if an issuer goes belly up?
Those are critical questions. Supporters of the bill argue that requiring issuers to hold one-to-one reserves will prevent those kinds of collapses and provide a more secure foundation for stablecoin transactions. But critics point out that the bill allows for investments in assets that have required bailouts in past crises, like money market funds and uninsured bank deposits. They argue that this creates a moral hazard and could ultimately expose taxpayers to further bailouts.
It seems like both sides have valid points. It's a tough call. And speaking of tough calls, Intel is facing some major decisions with Lip-Bu Tan back in charge. Will he split the company, pursue a joint venture with TSMC, or chart a completely different course?
It's a pivotal moment for Intel, that's for sure. Their stock has taken a hit recently, and investors are eager for decisive action. Tan's track record suggests he's not afraid to shake things up. But the situation at Intel is incredibly complex. They're facing fierce competition in a rapidly evolving industry, and the stakes are incredibly high. Whatever path he chooses, it will have significant implications for Intel's future and the tech landscape as a whole.
Right. Let's take a step back for a moment and reflect on what we've covered so far. We've discussed anxieties around AI leadership, changes, market volatility, and even the possibility of an Elon Musk stablecoin. What stands out to you as the most important takeaway from all of this?
For me, it's the realization that the financial world is becoming increasingly interconnected and complex. The lines between tech finance and geopolitics are blurring, and events in one corner of the world can ripple across the entire global economy. It's a reminder that we need to approach financial decisions with a holistic perspective, considering not just the immediate numbers, but also the broader context and potential long-term implications.
I couldn't agree more. This deep dive has been a whirlwind, but it's been incredibly insightful. It's clear that we're living in a time of rapid change and uncertainty, but it's also a time of incredible opportunity. The key is to stay informed, be adaptable, and never stop learning.
Well said. Now, are you ready for the final stretch of this financial roller coaster ride?
Absolutely. Bring it on. Our listeners are ready for anything at this point. All right, let's get back to business with another tech company that's been making headlines, but not for the reasons they'd probably like Adobe despite exceeding expectations for their recent quarter. And highlighting their AI investments is still being labeled an AI laggard. Their stock took a hit, and Wall Street seems unconvinced.
It really does seem like investors are demanding more than just talk when it comes to AI. They want to see tangible results and a clear path to profitability. It's not enough to just sprinkle some AI magic on your products and expect the market to go wild.
So you're saying it's a show-me-the-money situation for Adobe.
Mm-hmm.
They might be making progress with AI integration, but they need to demonstrate how these initiatives translate into actual business value, or they risk falling behind.
Exactly. And this brings us to a company that's having no trouble attracting attention, DeepSeek.
Hmm.
They've got potential investors lining up, but their founder is turning them away. It's a fascinating display of confidence, almost bordering on audacity.
It's definitely a power move. Liang Wenfeng seems to be playing the long game, prioritizing control and his long-term vision over short-term gains. He's betting that DeepSeek's technology is strong enough to attract investors on his own terms, even if it means leaving some money on the table for now.
It's a gamble, but it could pay off big time if they succeed. This approach really contrasts with the typical Silicon Valley mindset of growth at all costs. DeepSeek's strategy is a refreshing change, and it'll be interesting to see if other startups follow their lead.
It also speaks to the shifting power dynamics in the tech world. We're seeing these non-traditional players like DeepSeek emerging and challenging the dominance of the big Silicon Valley giants. It's creating a more diverse and dynamic landscape, which is ultimately good for innovation and competition.
I agree. And it's not just about geography, it's about a different mindset. DeepSeek's founder seems to be driven by a different set of values. He's not chasing a quick billion-dollar IPO. He's building something with a deeper purpose.
Okay, let's turn our attention back to the U.S. market, where trade war anxieties, recession fears, and political turmoil are making things pretty volatile. Some analysts like Tom Lee see this dip as a buying opportunity, while others are recommending caution.
It's a classic battle between the bulls and the bears, with each side making compelling arguments. Lee's optimism is based on historical trends and his belief that the U.S. economy is more resilient than many people think. On the other hand, those urging caution point to the many challenges facing the market, like rising interest rates and geopolitical tensions.
So who's right? It's a tough question, and there's no easy answer. It seems like the best approach for investors is to do their homework, understand their own risk tolerance, and make informed decisions based on their individual goals.
Well said. It's a good reminder that investing isn't about trying to predict the future. It's about managing risk and positioning yourself for success over the long term. It's about finding that sweet spot between optimism and realism and being prepared for whatever the market throws your way.
Speaking of being prepared, let's talk about the Genius Act and the potential for stablecoins to disrupt the financial system. It's a complex issue with strong opinions on both sides.
Absolutely. Supporters of stablecoins view them as a revolutionary technology that could democratize finance and empower individuals. They believe regulation is necessary to protect consumers and encourage innovation. Opponents, however, worry about the potential for systemic risk money laundering and even the erosion of national sovereignty.
It's a high-stakes debate with huge implications for the future of finance. The outcome of this bill will likely shape the regulatory landscape for years to come, so it's something we'll be following closely.
This deep dive has taken us from the heart of Silicon Valley to the halls of Congress, and it's clear that the world of finance is in a state of constant evolution. We're seeing a convergence of technology politics and economics, creating a complex and often unpredictable landscape. But amidst all this uncertainty, one thing remains constant: the need for informed, thoughtful, and responsible financial decision-making.
I couldn't have said it better myself. So as we wrap up today's episode, I want to leave our listeners with a few key takeaways. First, the AI revolution is here to stay, but it's about more than just hype. It's about delivering tangible results and creating real value. Second, we're seeing a shift in power dynamics within the tech world, with non-traditional players like DeepSeek challenging the status quo. And finally, the financial world is becoming increasingly interconnected and complex, which means we need to think holistically when making investment decisions.
Those are excellent points.
Yeah.
And I'll add one more thought to that. In a world overflowing with information and constant change, it's more important than ever to be a critical thinker, to question assumptions and to seek out diverse perspectives. Don't just follow the crowd, do your own research and make decisions that align with your own values and goals.
That's great advice. We'll see you all tomorrow morning with fresh headlines from the major financial magazines. Until then, stay curious, stay informed, and happy investing.